huge supply shock, which is not just about energy. There's all kinds of other stuff that goes in and out of the Gulf region. It's economically vital in a variety of ways. That is probably going to be, unless it's quickly resolved, that's going to be as bad as anything we saw in the 1970s.
Hello and welcome to the MoneyMagpie Invest podcast. I'm Jasmine Birtles, founder of MoneyMagpie.com. And before I start, remember you need to subscribe, you need to like, you need to comment. We're very interested in your comments, and tell all your friends how fabulous we are. Well, today I've got my friend John Butler here. Now, John is a former city man from Deutsche Bank and Lehman Brothers. And he's also now the author of the Amphora report, which you can find on Substack. John, hello there.
Hi, Jasmine.
Great to have you, John. Now, you've been reporting on world events, economic events, and particularly American economic events. And you're not that thrilled by what's happening. So I just thought we'd start with America. What's the situation, according to your Amphora report? What's the situation with the American economics? The economic situation in America right now.
Well, it's not great is the short answer. Let me give a little additional background there and some context so you can better understand how I approach economic analysis generally and specifically the United States. It was part of my remit for many years in the city to work with economics teams and to try and get a sense of what was happening fundamentally with the global economy. And the US, of course, is a huge part of that. And so I learned a lot. I learned a lot from my colleagues while my role was investment strategy and implementation. Nevertheless, I learned a lot from my colleagues regarding the fundamentals. And one thing that I learned quite early on in my career, actually, is that big headline economic data tends to not really tell you as much about the future outlook as some of the more subtle subcomponents and certain other indicators that have better leading properties. And so you need to look behind the headlines, basically. And so I still do that. I still do that from time to time in my Substack, and maybe 2 to 3 times a year. I believe it's appropriate to take a look. And when I apply that approach to the United States over the past couple of years, I've seen a picture that is consistently weaker behind the headlines than the headline numbers suggest. And in fact, I've almost been, well, proven's a strong word, but I've received some reassurance over the recent months, that my approach has in fact been correct. My analysis has been generally correct because to the extent there have been data revisions, in some cases very large data revisions, such as to labor market and jobs growth data, they've all been down. In some cases, very, very strongly down. They erased 1 million of jobs from the US workforce last year because they had been overestimating the size of the workforce. And that ripples through other economic statistics. The fact is, estimates of GDP and growth generally, they have to square with whether you're actually growing jobs or not, with whether productivity growth is increasing or not. It all has to line up, and if it doesn't line up, then the economics profession goes back and do what they call benchmark revisions. They literally go back years at a time sometimes and adjust the benchmarks so that they in fact do line up more consistently with one another, because they kind of have to. You have to, end up getting these things to add up. So the bottom line is this, is that the economics profession, the mainstream, has been consistently overestimating the strength of the US economy. Not by some wild, huge amount, but maybe say 0.5% to 1%. But the problem is that's enough. If you backdate that to the last couple of years, that leaves the US nearly teetering into recession for a sustained period of time. And so, so our starting point isn't great looking into the rest of this year is what I'm getting at.
What I'm hearing from friends in America, and of course it's the same here, is that prices are going up, and they're not going out to eat so much, they're not doing this so much, they're not doing that so much. So that must have an effect.
Oh, it certainly does. I mean, in a modern mature economy, consumer spending is about three-quarters to 80% of it, and some of that comes from the government in terms of
Hmm.
government transfers that people receive benefits and they spend. So I'm lumping that in with it, okay? And then investment in net exports are the other components. And you also get swings in inventories, which you can adjust for, and it's important to do so to get a proper, consistent picture of what's
Mm.
really going on with the economy. But yes, the fact is that when you get into an inflationary environment, economists actually struggle to measure in real time what is actual real economic activity and what's just the price level swinging around, in this case, going up. And so they tend to believe that consumer behavior tends to change only very slowly over time. But other factors equal, if you get into an inflationary environment, it's a net negative, and people do start to make difficult
Yeah.
choices. They do start to cut back. And
Hmm.
that is one reason why I believe we're going to continue to see downward revisions to the last few quarters of data, not just in the US, possibly elsewhere, but certainly in the United States. I believe that will be happening.
So here's a conspiracy theory for you. The Iran war, was that set up in order to cover this economic problem and the other economic problems that those in the know are expecting?
I mean, look, I of course would have no knowledge of that. Hi history does suggest, however, that times of economic hardship sometimes do lead to conflict. And
Mm.
if that's because that's a conscious decision on the part of, whatever elite is in charge at the time, or whether it just sort of works out that way, I mean, historians will argue about that sort of thing forever. The timing, I believe, though, is with we have to look at the background here, right? This conflict has been simmering in various forms for an awfully long time.
Yeah, yeah.
And it has gone hot a couple times over the last couple of years. But the underlying background here is that the Gulf region is simply inherently unstable. It's been
Right.
inherently unstable ever since World War One, if you want to go back that far, and the breakup of the Ottoman Empire, and the way the borders were drawn bore no semblance of reality vis-a-vis the actual division of the various groups, ethnic groups in the Gulf region. And then of course you had the Iranian Revolution, which flipped the tables on the relationship that Iran had with the rest of the region, and so on and so forth. So whether this specific current war is a political calculus to try and disguise what was a weakening U.S. economy, maybe. But the fact is that the region was ripe for a war anyway, if you ask me.
Okay, so what is it really doing? What's the war doing to the economy, to the world economy, but particularly to the West, America and Britain and Europe?
This is very, very bad news because take what we discussed a moment ago. The US economy has been weaker than it appears on the surface for a period of time now. And some downward revisions to data confirm that that's the case. I think those revisions will continue. So your starting point is already an economy that's weaker than the mainstream generally believes.
Yeah.
Then you have the tariff shock from last year that has still not fully filtered through, and the Supreme Court has now said that the way in which the tariffs were implemented is unconstitutional, and that throws a lot of uncertainty onto the tariff side of things.
Mm-hmm. Mm.
But the fact is that Trump can ju there are ways to play a bit of a shell game here regarding how you justify the tariffs. It's not clear Congress will go along with it and allow them to be reinstated in some other form. But that tariff shock has not yet fully filtered through into prices, into economic activity, and into corporate profit margins. This is what you need to realize. Other factors equal, tariffs can wreak havoc with corporate profits in a variety of ways.
Yeah.
And now you get this huge supply shock, which is not just about energy. There's all kinds of other stuff that goes in and out of the Gulf region. It's economically vital in a variety of ways. that is probably going to be, unless it's quickly resolved, that's going to be as bad as anything we saw in the 1970s. Now, there were two so-called energy shocks in the 1970s.
Yeah.
One occurs fairly early on,
Yeah.
1973,
As
74,
mhm.
and the other one occurs around the time of the Iranian Revolution at the very end of the 1970s and into the early 80s. This is going to be worse than either of those. I mean, that's what it's looking like. It's going to be even worse. So you take an economy, a global economy, U.S. economy that already wasn't doing great, and then you throw this at it, and it's really, really going. I'll be amazed if we don't go into a very, very noticeable recession in the global economy, which is going to affect everyone.
Everyone and
No,
everything.
no one is going to escape that. And that is going to wreak havoc with corporate profits. And that's going to be a real issue for the stock market, which is trading at a historically high valuation in terms of ratios, price earnings ratios, EV to EBITDA ratios, other ways in which analysts go about deciding whether whether share prices are richly valued or not richly valued and so on. It doesn't look good. It really doesn't. And I mean, that jumps to the next topic, perhaps, but this is why I'm extremely defensive in my investment allocations at present.
Yes, because I was going to say I would have thought that gold would be much higher than it is at the moment. It seems to be just going at the moment.
Well,
Why is it?
if you step back from the chart, let's not forget that gold had a phenomenal run for a
Yeah,
couple of years there
true.
before it suffered that sharp setback earlier this year. And there are several ways to possibly interpret that. Number one is a lot of hot money had been drawn into the market and it was going to leave at some point anyway. And you never know
Right.
exactly what's going to trigger that. So that could be pure market dynamics, right? Just pure statistical noise. That said, it corresponded with the outbreak of war. So that could be more of a buy the rumor, sell the fact dynamic, where people anticipate there might be a big event, in this case, war breaking out, but then immediately start taking some profit when the event
Mm-hmm.
finally
Mm-hmm.
arrives.
Mm-hmm.
They might leave some on the table, but they take some off. That's a traditional market dynamic too. So these are things we're thinking about. The final one that I'll put out there is while gold again did extremely well going into this, certain other commodities, including what I would call war commodities, that is
Yeah.
essential commodities for conducting military operations. Look, if you get into a war situation, people are going to need those, and they will liquidate other investments as necessary to acquire those.
Mm-hmm.
And precious metals might have got caught up in the fact that everyone needs oil and oil is more expensive. Everyone needs LNG and LNG is now more expensive. Everyone needs industrial metals. They're now more expensive. So it could be some shifting around also that was taking place there. But
Mm-hmm.
it could be all of the above, right? All these explanations have some merit in my opinion. However, looking forward, if you step back from the chart, and I'm not a big chartist, but you still have to respect them now and again. You step back and you take a look at the last few years for gold and also silver for that matter. It looks like a pretty traditional consolidation. And we've just entered into a period of what is effectively sideways trading.
Mm-hmm.
And so then you have to ask yourself, well, okay, what gets us out of that, if anything? And how long do we have to wait? Well, the fact is that, war is expensive.
Yeah.
Governments are already running deficits. Debts are already historically high. There's still a lot of leverage in the financial system. In fact, if you include private credit, which is very difficult to analyze because so much of it's kind of almost hidden from view, call it a form of a shadow banking system, as it were. There's all of that sloshing around. Governments have had this tendency in recent decades, every time things get really dicey, they ultimately find some way just to throw more money at it and to
Yeah.
finance that by easing interest rates, easy central bank policy. And these are things that are fundamentally precious metals positive.
Mm-hmm.
We're just going to go through another round of that, if you ask me. So gold and silver are consolidating for now, but just you wait. If I'm right, and the economy is already weak, and this is a big blow that makes it even weaker and tips the world into outright recession, there's going to be fresh debt thrown at the problem. There's going to be fresh money printing to finance that debt. And precious metals are going to get right back into a bull market. I'm
Yeah.
quite confident of that, actually.
Well, that's good to know because, yes, I'm a fan of precious metals as well. So it's good to see that you're thinking similar to me that it's just in a lull at the moment. It's going to go up again. And you've written now what's give me the name of your latest book on the gold standard.
It's called The Golden Revolution Revisited.
That's it.
And what it
Yes.
does is it takes a look at basically the way the world is today, but assumes that for a variety of reasons, gold is going to be remonetized as an
Hmm.
actual way for countries to settle their external trade and investment imbalances with one another. Those imbalances are historically very large. And there's two ways you can reduce them. You can kind of just inflate your way out and everybody devalues like mad. Or you can actually do that together with resetting the system by beginning to use gold again.
Okay.
And so I run a game theory dynamic on that in the book. That is, if everyone's trying to devalue versus everyone else, then in fact what everyone's effectively doing is revaluing gold, whether they're conscious of that or not. And ultimately, what that means is that people will begin to prefer around the margins to accept gold as payment rather than to accept other countries' currencies as payment, and you end up with that being the new equilibrium. So I walk through that in the book. I also talk about a lot of other things, alternative economics, and the final section is practical investment advice
Hmm.
for a world that's moving in that direction.
Great. So finally, John, what's your recommendation to investors right now?
I'm overweight what I call essential basic industries as well as precious metals. And those essential basic industries include mining and materials more generally, energy, chemicals, agriculture. These basically what puts food on the table, what keeps the lights on, what keeps a roof over your head, it doesn't matter how much inflation there is out there. That area is pretty bulletproof if you get into a sustained stagflationary, weak growth environment. Everyone needs food, clothing, and shelter. Everyone is going to cut elsewhere before they cut that. And that may seem a very kind of depressing investment thesis. It's like, oh, isn't there some area that's going to grow really quickly? Isn't there, some way to treble your portfolio in this sort of environment? I don't think there is. I really think it's a time to be properly defensive. Now, the good news is those basic industries, basic essential industries I mentioned, tend to be mature companies, of course.
Hmm.
And mature companies tend to have fairly steady earnings. Maybe not, spectacular growth, but fairly steady earnings. And they pay out dividends. And even with inflation where it is today, we're running slightly above 3%. That's probably going to climb another several percentage points as a result of the energy shock and whatnot. But you can find dividends on that order. That is, you can find dividends in all of these basic industries I just mentioned on the order of 5, 6, 7% if you shop around a little. And that should help to protect you from the inflation and allows you to benefit to the extent that there is some growth around the margins there.
Okay. Well, John, I know you run your own portfolio, and people can copy your portfolio, can't they?
Well, that's part of the consulting services that I provide is someone will show me their existing investment process. It might be a family office or other. Usually it's a relatively high net worth investor, and they'll show me their investment process, and I'll say, okay, well, if you do want to prepare for a difficult, prolonged, stagflationary environment, this is how I would adjust it.
Hmm.
And ultimately, we get into a discussion about specific companies and specific investments. But yes, I offer that on a bespoke basis. And also, I do run a more sort of, you could say, standardized
Yeah.
service that is a simple variation on everything I've just described, which is something that I can provide for much lower cost, basically. And that would be provided to a more typical household savers.
And they can get in touch with you through the Amphora report.
Yes, that's right.
Great. Well, thank you. Thank you very much, John. Thank you for your analysis. And for more analysis from John, go to the Amphora report on Substack. So thank you so much. That's been John Butler, who is the author of the Amphora report on Substack. Thank you for watching. This has been the Money Magpie Invest podcast. I'm Jasmine Birtles, founder of Money Magpie. Subscribe, like, comment, tell us what you think, and come back next week.